Good morning, everybody, and welcome back to Beat the Bell presented by King Capital. Hope you guys are all having an awesome morning and an awesome trading week thus far. So the CPI print came in this morning. We'll talk about that in just a couple minutes, but the immediate market reaction is obviously positive with the S&P futures absolutely ripping to start here, trading 45.07 on the September contracts. Really good stuff to see. We'll be talking about how we've been trading so far this week, how we got along earlier in the week, later on in the show. But before we do that, let's bring on today's panel, starting with Money Mander. Money Mander, good morning.
Good morning, long and strong. We actually just got below 5% here on core CPI for the first time in over a year. So we'll be talking about that in a second.
All right. And Diamond Trades, good morning.
Good morning, Alejandro. Insane market move. Ready to dive into it.
All right, awesome stuff. Let's get straight into Fed forecast and economic calendar.
For sure. So we can start
with
hold on. The economic.
Hold your horses.
Oh, hey now.
Snipa, good morning.
Good morning. Very important that I say good morning. I was like, what the hell?
Dude, I honestly, sometimes you show up 8:40, 8:45. It's just,
you never know.
Anyways, let's proceed. I just didn't want to miss you there.
Oh, let's get after it. Economic calendar. Put it up. All right. So obviously core CPI and CPI this morning. We're going to touch on that extensively in a little bit. Still some news to come. So this really sort of kicked off the high impact news for the week. We've got PPI and core PPI tomorrow, as well as initial jobless claims. And then on Friday, we've got UMISH consumer sentiment, which is going to be important. So some more high impact news to come. This was sort of just the start of the week as far as high impact news goes. But as Sal touched on, CPI just came in about 8 minutes ago. So CPI, the headline number, actually came in at 3% year over year, which is 4% in the previous month and a little bit below expectations of 3.1 and 3.2%. So like more or less in line. Core CPI, which has really been the focus here in the past several prints, came in at 4.8% versus 5% expected and 5.3% previous. So both readings under expectations, both readings down from the previous month. That's exactly what you want to see. It's exactly what the markets want to see, and we're getting a massive pump here to start the week. So the start of the week really has been choppy as we sort of awaited this data, and which really again started today. Yesterday the Dow was up, I think, or the Dow, the S&P and the Qs were up about 0.9, 0.7, and 0.6% respectively. Yields have also been on the rise as of late, with the 2-year sitting at about 4.8%. Up from the May low of 3.65%. I would love, Sal, if you could go ahead and check out where that is trading as this morning after the news here. While yields have certainly looked attractive here, though, the bond trade isn't necessarily as easy as it appears, right? In the off chance that the Fed holds rates steady, though it is unlikely, I guess possibly made a little bit more likely now that we've gotten this very cool CPI print, but still considered widely, unlikely by the market in terms of pricing. Yields would definitely take a hit as bond prices rebounded. But then on the other hand, you have earnings season coming up, right? And so if companies are to, report earnings that are sort of above consensus and really raise that forward guidance going into the end of the year, that can make stocks look even more attractive than they are at these levels. I mean, the S&P 500, as Alejandro talked about, literally as we hopped on, took out that previous week's high and is now trading at a year-to-date high of 48.05. I believe it's a year-to-date high. Don't you want to fact check me on that? It is a year-to-date high. I knew it. Year-to-date high of 48.05. So I mean, it's even though yields are sitting at a pretty attractive level here, especially the 2-year. This is basically where the 2-year topped out back in March, up here at this just above 5%. We got very, very close, up at like 4.94%. In terms of the 2-year yield, now starting to come back down this morning, trading at 4.73 this morning versus 4.8 yesterday, 4.87 yesterday. So yields are starting to pull back a little bit on the CPI news, and stocks obviously getting the rally. One thing to note is that the NASDAQ did not take those year-to-date highs yet. So if you're a trader intraday, that might be something that you're looking for in terms of upside targets on the NASDAQ. Last thing that we'll touch on before we get out of here is this note out of Goldman about the current financial conditions. So Goldman believes that financial conditions are not as tight as many believe, including the Fed, arguing that the Fed's newly published economic index overstates the level to which previous rate increases will slow economic growth going forward, which would imply turbulence for all markets, not just the stock market. According to Joe Lynch, it simply has not, this is a quote, it simply has not been that hard for businesses to get access to capital this year, particularly at fair, reasonable rates. When you're looking at where deals are pricing, it is simply not that onerous on borrowers. So one thing to point out here is that, contrary to popular belief, the primary factor, that goes into determining whether financial conditions are getting tighter or not is not necessarily where the Fed funds rate is on an absolute sense, but rather where the Fed funds rate is in relation to that theoretical natural rate, the rate at which the economy would neither grow nor contract, right? So whatever that theoretical natural rate is, if the federal funds rate is above that, you can consider financial conditions to be tight. If the federal funds rate is below that, even if it's higher than it has been over the past 10 years, you consider that to be not necessarily extremely restrictive, right? And so the theory here is that, again, this natural rate, you cannot directly measure it, which is obviously what makes it difficult, and it's constantly moving, right, based off of the economic outlook and what we're seeing in the broader economy. And so that's really what makes it tough for to get a definitive answer. Are financial conditions tight enough to cause some contraction in the economy, maybe slow down growth and really bring down inflation, which is obviously the Fed's goal. You look at the strengthening economic metrics like ISM, the tight labor market, and constantly increasing GDP estimates, and it's hard to believe that financial conditions are significantly tight enough to really slow growth. Sal, what do you think about this?
Yeah, I would agree. And I think the big point here is that while it's not directly measurable, as you stated, with the natural rate, really all you can look at is the Fed accomplishing its goal. And so my segue here is actually great to move away from Goldman's theory into where inflation has been going in the U.S., especially as compared to the Eurozone. I just saw this story that the way the U.S. Bureau of Labor Statistics calculates CPI and core CPI is different than they calculate it over in Europe, in that we include an imaginary figure. We include a figure called owner's rent equivalent. And so this is for homeowners. It would be their imaginary rent price should they be renting their home. So even people in the country right now that own their homes fully cash, they're calculated into this on what they would imaginarily be paying in rent. Obviously, that's going to keep inflation elevated. And in Europe, they don't include this because it's really not an actual expense. It's not something that the economy is actually paying. And so in our sense, we just came in at 4.8% in core CPI year over year today. Right in Europe right now, I think it's at 5.5, and the gap between the two is 2%. So if we were to go ahead and calculate our current inflation with the Eurozone's calculations, right now we would be sitting under 3%. We would be right around 2.8% year over year, clearly accomplishing their goal. And so I think it's hard to directly measure in one number whether the conditions are restrictive or not, but clearly they're getting inflation bottled up here. I mean, you can see here's your gap right now. So two ways to take this. Either Europe is currently sitting at like a 7.5% core inflation year over year, or really we're accomplishing our goal here and we're getting down under what would be 3%. And even coming in under 5, we're clearly getting our mission accomplished here. So I don't know, restrictive or not, we'll see. Really, I think this is going to get down to, as we're getting to, as I mentioned before, housing prices getting taken out of that really sticky calculation in inflation, which clearly is what's bringing this down now as we're getting into the end of the year here. We'll see as we get towards that like 3% on core, whether they're able to get it from 3 to 2. I think that's where it's really going to be tricky.
Right. Last thing before we pass it back to Alejandro, so we talked last time that Jerome Powell came out. They at the last Fed meeting in June, they basically didn't raise rates, but all but promised a rate hike in the July meeting that's going to come at the end of the month here. And so the probabilities for a no rate hike was sitting at about 7% before this data came out. This soft inflation data, and after the data, it's sitting at only 10%. So it only got a 3% bump, even with CPI and core CPI both coming in below expectations. The market is still of the belief that Jerome Powell is going to keep rates stagnant going into the next meeting. So that's all we've got for you here on Fed Forecast. We will pass it back to Alejandro.
All right, guys, we're going to do things a little bit differently today. We are going to go straight into Beat the Bell with Stock Snipa.
Here's the standings. Just so you know, I want to put myself at the bottom just because I host it and I want to be humble. That's all on purpose. I've intentionally lost 23 times, but I would have known the right answer all 48 times. Let's get right into it, guys. I don't like these faces I'm getting on the side. Green or red? First question of the day. Diamond, what you got?
Gotta go green. I mean, the market's up, 0.5% from before the print, and I think 0.8% from yesterday's close. I have to go green. Don't have a choice.
Mander, what you got?
Yeah, we'll take the free win here. The SP 500 into fresh year-to-date highs. I clearly think we stay green.
Hondo, what you got?
Green.
I'm going to have to take green as well myself. Seems like green is the verdict, especially with the CPI news. So we got some interesting questions today. First question I'm going to ask you guys. I don't want to see anybody angry in the comments for me even asking this, but would you guys rather have 1 million in cash today or 3 million in cash in Coinbase commons that you cannot sell for an entire year, no matter what? What are you going to take, Diamond?
$1 million cash today or 3 million Coinbase. Just I have to hold it for a year though.
You have to hold it for a year under any circumstance.
I mean, Coinbase. Yeah. Coinbase could go down 50% and I would still win money. Is essentially what you're saying. So as long as Coinbase doesn't drop 66% or more,
it could go down 99% and you would still technically win money. Have more than what you started with.
Yeah, but versus the million.
Shut up. I'm just saying.
So 66%.
Math has never been your strong
suit. Lows is your break even.
Math has never been my strong suit. Yeah, no. So you would, as long as it doesn't make new all-time lows. So the all-time low, right? Is this the all-time? The all-time low is $31, and 66% drop is $30. So as long as it doesn't make an all-time low, I'm straight. I'm gonna go with the Coinbase stock.
I see. I like that. Yeah. Exactly. $30 is pretty much your
break. Yeah. Break even.
Hondo, what you got?
I'm definitely going with coin. Also, I mean, the stock's been pretty electric as of late. I know that there's been a high beta, kind of short squeeze theme going on, but Coinbase is interesting because through thick and thin, they've managed to kind of stick around. I feel like every month or so, there's a major headline that just seems like this stock is going to get absolutely washed. And here it's still, you see, I said it was trading at 90. I haven't even looked at it. Like that's pretty crazy. I mean, I think that Coinbase is going to be a major player, especially if we get more risk on. And Bitcoin also has endured a lot as of late. I would have no problem holding 3 million in Coinbase. I mean, you definitely it is high beta, so you'd have to withstand a lot of volatility. There would be some crazy ups and downs that would not be good. But I think at the end of the day, you're walking away with at least $1 million.
It's doubled in the last 35 days.
That's crazy.
Yeah.
What a great stock. Because it sold off on that on the SEC news or whatever it was. And
Yeah.
Buying opportunity. Come on. That's funny.
Mander, what you got?
I'm going to take coin as well. And while the stock has absolutely been ripping the past month, as Diamond said, it's really only trading at $90 here in the pre-market. And let's not forget this IPO'd over $400. And so while the short squeeze has clearly been on, squeezing out last year's shorts, there's shorts that are still in this thing from 2021 that are still green. And so I think this really has potential to continue going. I'm definitely going to take the coin shares here.
Question was a lot better in my head. I feel like it's a no-brainer. Next question I got, which is this one I know for sure we will have some controversy on this one. Will SPY hit 450 by the end of July? Diamond, what you got?
Ooh, yes. It's pretty close. We're at 445 in pre-market. I don't think we'll have that much controversy. I think everybody's going to say yes, personally.
Okay. Mander, what you got?
End of week.
End of July.
End of week. We're like 1% off. We're 1% off of 450 right now.
Okay. End of week. SPY 450 by Money Mander right there. Hondo, what you got?
I think a better question is, will SPY hit 450 in the next hour or so? This thing, we're getting a major breakout here over the triple top, the July highs. If we can hold this area, I mean, this starts a new leg. So I think that the smart bet, at least in this area where we're currently trading in the pre-market, is that absolutely we hit 450.
I think
not to mention we've been talking about seasonality, right? July green 75% of the time, and this puts it only slightly green. We're still slightly green. So one of the most bullish months, and we're finally green on the month, right?
I was gonna say too, SPY was
where the S&P was trading at the start of the month, but
like
we haven't made any gains.
444. So we're breaking green right now from the start of the month.
Okay, yeah.
But tech was in the gutter really the past like 4 sessions, and so I think if the Nasdaq reverses with SPY already resilient, we're gonna see a crazy squeeze here in the S&P.
Agreed.
Yeah, in my defense, this was pre-CPI, but still not the biggest difference.
Definitely better question pre-CPI. I understand that.
Yeah, but that'll wrap it up for Bet the Bell today, guys. I'm passing it back to Hondo here with the trade of the week.
All right, guys, we're gonna wrap up with trade of the week here.
It's time for America's Trade of the Week.
Now, here's a guy who knows how to trade stocks.
All right, guys, so we got a graphic up on the screen here. So far this week, we've seen some really nice trend higher after what was a false breakdown that was put in early in the week. So 44.20 was last week's low. It was also a previous breakout spot from the June 28th, 29th rally. And so this was a major level. And early Monday morning, we got a flush below this level and a reclaim. And what this does, as I have written there on the screen, is it stops out longs, and on the recovery, it stops out shorts. And this is typically how most major moves start. And so I took the entry there, and I've just been managing runners. I have traded around the position a couple times. I added a little bit more yesterday, took some back off, but I still have that core position from the initial entry. And yeah, I guess that's the trade of the week because it's 85 points in profit now. So absolute ripper, but just continuing to trail stops, and that's that. And glad that we've been able to catch this move. All right, that's going to do it for this morning's show. Appreciate you guys for tuning in. Looks like they weren't able to see the slide there. If you guys weren't able to see it because of technical difficulties, what you can do is you can go to my Twitter, and I just tweeted it, so you can get that same screenshot and take a look, and that should should make it make more sense. Apologies for that. That's going to do it for this morning's show. Appreciate everybody who tuned in, and we will catch you guys back here on Friday morning. We'll be trading live in KingCap all day. You can go to king-capital.com or scan the QR that might be popping up on the screen here. There it is. Other than that, we'll see you guys on Friday morning. Have a good one, everybody.